Current price, $6.47 USD. Intraday movement, minus 0.46%. Consolidating near deal value. The numbers flashing on your screen right now, $6.47, are not just a price, they are a tombstone. As we speak, Hanesbrands Inc. is navigating the final, fragile seconds of its independent existence, hovering with a deceptively stillness at $6.47, down marginally by roughly 0.5% on the session. To the untrained eye scanning a watch list on a Robinhood app, this looks like a boring, low-volatility day for an apparel maker. The expectation is that this is just another Tuesday in the slow, grinding world of consumer staples, where you might pick up a few shares for a dividend play or a value bounce. That is the expectation. The reality is violently different. You are looking at the terminal value of a corporate history that spans over a century, currently being dismantled and reassembled in real time. We are witnessing the precise moment where Hanesbrands ceases to be a stock and becomes a currency conversion mechanism into Gildan Activewear. This isn't just a trade. It is the absolute end of an era for a ticker symbol that has been a staple in individual brokerage accounts for decades. And if you don't understand the mechanics of what is happening to your capital right now, you are flying blind into a corporate merger that changes the very DNA of your portfolio. Let's strip away the noise and look at the raw expectation versus the brutal reality. The expectation among many retail traders, perhaps those discussing the stock in forums or checking their SoFi Invest dashboards, has been that Hanesbrands was a deep value turnaround play, a return to glory story where the company would shed its debt, fix its supply chain, and climb back to double digits on its own merit. Investors looked at the sale of the Champion brand earlier this year and thought, here comes the liquidity, here comes the freedom. The reality, however, is that Hanesbrands ran out of runway to execute that turnaround alone. The reality is that the $6.47 price tag you see is not based on earnings multiples or future cash flows of Hanesbrands. It is mathematically pegged to the acquisition terms set by Gildan Activewear. You are no longer holding a stock. You are holding a contract that entitles you to a fraction of a Gildan share and 80 cents in cash. The disconnect between those who think they are buying a dip and the arbitrage funds that are penning this price to the penny is where retail capital gets incinerated. While you might be comparing this chart to Tesla stock or hoping for a volatility spike like Nvidia stock, the market makers are treating Hanesbrands as a solved equation, not a speculative asset. To understand why we are sitting at $6.47 today, we have to dissect the chaotic 12 months that led to this acquisition completion. When you log into your Fidelity trading platform or check your Schwab Intelligent portfolios, you likely saw Hanesbrands lagging the broader market for years. The company was suffocating under a debt load that at one point exceeded $3 billion, a number that became untenable in a high-interest rate environment. The management team made the drastic, some would say desperate decision to sell the crown jewel, Champion. When that sale to Authentic Brands Group was finalized, it was the first domino. It brought in cash, yes, but it also stripped Hanes of its primary growth engine. Without Champion, Hanesbrands became a pure innerwear company, stable, cash-generative, but utterly unexciting to growth investors. This vulnerability is exactly what Gildan Activewear saw. They didn't see a competitor, they saw a distressed asset with a legendary distribution network. So when you see the stock barely moving today, realize that this is the market acknowledging that the war is over. The Hanes you knew is now effectively a subsidiary, and your investment is morphing into something entirely different. If you are currently holding HBI shares in a Robinhood cash management account or through Fidelity Investments, you need to understand the immediate mechanical implications. This isn't like buying Apple stock and holding it forever. Upon the final closing of this deal, which is practically occurring as we speak, your shares will be extinguished. In their place, for every single share of HBI you own, you will receive 80 cents in cold hard cash and 0.102 shares of Gildan Activewear. This structure is critical. It means your exposure has shifted 180 degrees. You are no longer betting on a turnaround in Winston-Salem. You are now a passive investor in a Canadian-headquartered apparel giant. This shift catches many self-investing enthusiasts off guard. You might have bought Hanes for the dividend yield or the brand loyalty, but you are waking up owning a piece of a vertically integrated manufacturing behemoth that operates with a completely different philosophy. Let's go deeper into the market behavior we are seeing today. The volume is steady, but it's not retail volume. It's institutional arbitrage. Hedge funds and high-frequency traders on interactive brokers trading terminals are buying HBI whenever it dips even a fraction of a cent below the implied deal value and selling it when it ticks above the implied deal value. They are harvesting the spread, however tiny it may be. This creates a magnetic effect on the price. If you are a retail trader trying to swing trade this, you are fighting algorithms that know the math better than you. It's a stark contrast to the wild, sentiment-driven moves that we see in Robinhood crypto markets or high-beta tech stocks. Here, the price is governed by a legal contract, not market sentiment. This is why the stock feels stuck at $6.47. It is waiting for the official delisting notice. If you are using investing sites that show technical indicators like RSI or MACD for HBI right now, throw them out. Technical analysis fails when a merger is the defining gravitational force. Support and resistance levels don't matter when the company is being bought out at a fixed ratio. Comment below how many shares of Hanesbrands you currently hold and whether you're planning to keep the Gildan shares you receive, or if you're planning to sell the moment the conversion hits your account. I want to know if you believe in the new combined giant or if you were just here for the trade. Now let's look at the business itself, or rather the business that is being absorbed. Hanesbrands has always been a titan of basics. T-shirts, underwear, socks. It is the unglamorous plumbing of the apparel world. Unlike the flash of SoFi stocks or the tech-heavy portfolios you might build with investment help from a robo-advisor, Hanesbrands relied on volume and shelf space. They dominated Walmart and Target, but their supply chain was antiquated. They owned their own sewing plants in a world where competitors outsourced everything. For years, this was seen as a liability. However, this is exactly why Gildan Activewear bought them. Gildan is the master of low-cost, vertically integrated manufacturing. The expectation was that Hanes manufacturing was a burden. The reality is that Gildan believes they can strip out hundreds of millions of dollars in costs by integrating Hanes volume into their highly efficient system. This is the synergy buzzword you hear, but in this case, it's real. It means shutting down expensive legacy plants and moving production to Gildan's massive hubs in Central America and Bangladesh. We also need to talk about the macro environment that forced this marriage. The last 2 years have been brutal for the apparel sector. Cotton prices have fluctuated wildly, labor costs have skyrocketed, and the consumer, the person buying that pack of boxers at a big box store, has been squeezed by inflation. When you look at Fidelity ETFs that track consumer discretionary spending, you see the strain. Hanesbrands, with its heavy debt load, simply couldn't maneuver. They were paying so much in interest that they couldn't invest in marketing or innovation. This is a classic distressed value trap that often catches investors using online investment platforms. You see a low PE ratio, a low price to book, and you think bargain. But the market was discounting the bankruptcy risk. The sale to Gildan Activewear effectively takes bankruptcy off the table, but it also caps the upside. You won't see HBI go to $20. That dream is dead. You are now capped at the performance of Gildan. Let's discuss the Champion sale in more detail because it set the stage for today. When Hanesbrands sold the Champion to Authentic Brands Group for over $1 billion, it was a signal of defeat. Champion was the only part of the portfolio that had cool factor. It was competing with Nike and Adidas. By selling it, Hanes admitted they were just an underwear company. But here is the contrarian take. That was the smartest thing they ever did. It cleaned up the balance sheet enough to make them an attractive acquisition target. If they still held Champion, with its falling sales and confused brand identity, Gildan likely wouldn't have touched them. The boring business is what Gildan wanted. They wanted the Hanes brand, the innerwear, the sheer volume of units. So, in a strange twist of fate, shrinking the company saved the shareholders from a potential total collapse. What does the future hold for you as a soon-to-be Gildan shareholder? This is where the analysis shifts from a post-mortem to a forecast. Gildan is a much stronger operator. They have a fortress balance sheet compared to the fragility of Hanes. By combining, they essentially create a monopoly on the printwear and basics market. If you are holding these shares in your Fidelity IRAs, this might actually be a good long-term hold. The combined entity will have massive pricing power. When cotton prices rise, they can pass it on to consumers more easily because they control so much of the market. Unlike the fragmented world of Robinhood investments, where you might throw money at 20 different speculative plays, this is a consolidation play. The risk, however, is execution. Merging two massive supply chains is a nightmare. Cultures clash, factories get closed, unions get angry. If Gildan fumbles the integration, the stock you received could be dead money for years. Consider